Every time you tap send to transfer money to another bank, you're quietly burning anywhere from 15 to 50 pesos in transaction fees. For a typical user making 10 transfers a week for things like rent, groceries, or splitting dinner, that totals a 600 peso drain on your monthly budget, just for moving your own money. This cost has been a standard part of digital life in the Philippines, but the Bangko Sentral has just implemented a new pricing doctrine that changes the math for every major bank in the country. BDO, BPI, Metrobank, and Land Bank are among a growing list of institutions that have eliminated these fees. Others, like RCBC, have joined in by offering free transfers for your first 30 transactions every month. This pressure even reached the major e-wallets. While GCash and Maya haven't hit zero yet, they both just slashed their cross-bank transfer fees down to 10 pesos. This isn't a temporary promotion. To understand why notoriously profit-driven banks are suddenly walking away from millions in daily revenue, we have to look at the regulatory trap the central bank just snapped shut. The architect of this change is the Bangko Sentral ng Filipinas, led by Governor Eli Remolona Jr. In June 2026, the central bank issued Circular Number 1238. A new rule was established. Banks cannot charge more for sending money to a competitor than they charge for internal transfers without a specific mathematical justification. This scale shows the problem: free internal transfers versus external ones carrying a heavy 50 peso penalty. Now banks must mathematically justify this gap. The only real difference is a routing switch cost, which is just 1 peso and 50 centavos. By forcing banks to align their fees with these actual operational costs, the BSP has effectively removed the transfer fee as a viable way for banks to make a profit. Once the regulatory floor was lowered, it triggered a competitive race among the country's biggest lenders. When BPI and Land Bank announced they were moving to zero, it created an immediate risk for everyone else. If your bank is still charging 25 pesos, while the bank across the street is free, you have a very strong reason to move your account. This aligns with a broader government target, pushing the Philippines to a 70% digital payment adoption rate by 2028. To get there, they needed to make digital cash as cheap to move as physical cash. Circular 1238 also protects the smallest players. A sari-sari store earning under 250,000 pesos a month is entitled to zero-fee payments. By removing the cost for a neighborhood store to accept a digital payment, the central bank is targeting the final barrier that keeps the informal economy dependent on bills and coins. For the first time, the financial penalty for moving money between different Philippine banks has been removed. To make sure you're actually getting these rates, update your banking apps today. Banks like BPI and BDO have specified that the zero-fee tiers are tied to their latest software versions. You should also reconsider where your money is sitting. Since it no longer costs 50 pesos to move your emergency fund, you can instantly shift your cash to high-yield digital accounts that offer better interest without worrying about transfer friction. This allows for a hub-and-spoke strategy. You can use a traditional bank with a large ATM network as your central hub, where your salary is deposited, and then instantly distribute that money to various investment and savings apps without losing a single peso to fees. If your current bank is still charging you 15 or 25 pesos for a standard InstaPay transfer, they are now the exception. You have the leverage to move your money to a provider that has already adopted the new cost-based standards. Every peso you save on these fees is money that can stay in your savings or go toward your daily needs. If this breakdown helped you save some of that monthly budget, hit the like button, subscribe, and share this with someone who's still paying too much to move their own money.